Have you ever wondered how some people make a fortune in the stock market? It's a question that has puzzled many for generations. The stock market, a whirlwind of numbers, charts, and percentages, has always been shrouded in a cloud of mystique and intrigue. It's a world where fortunes are made and lost in the blink of an eye, a world that can seem impenetrable to the uninitiated. Yet, beneath this facade of complexity lies a system that is driven by principles and strategies. This is the realm of investing, a game of risk and reward, of patience and strategy. It's a world where the successful don't just rely on luck, but on a deep understanding of the market and its nuances. Unraveling this mystery isn't as difficult as it appears. It's all about understanding the process and making informed decisions. So, are you ready to step into the world of the stock market and unlock its secrets? Before we dive into the stock market, we need to understand the basics of investing. Investing is the process of putting your money to work with the expectation that it will grow over time. It's about growing wealth by buying assets that you believe will increase in value. One of the fundamental principles of investing is the concept of buying low and selling high. This means purchasing a stock or other investment when its price is low, and then selling it when the price has risen. It sounds straightforward, right? Well, it's easier said than done. Identifying the right time to buy or sell requires careful analysis and thorough understanding of market trends. Another key principle of investing is diversification. Instead of putting all your eggs in one basket, diversification involves spreading your investments across various types of assets. This way, if one investment doesn't perform well, others might be thriving. Diversification helps to balance the risk and reward by spreading potential risks. Moreover, risk management is an essential component of successful investing. Every investment carries some level of risk. The key is to understand these risks and manage them effectively. This could mean setting a budget for your investments, not investing more than you can afford to lose, or setting a stop-loss order to limit potential losses. Investing is not just about making quick profits. It's about making informed decisions and being patient. It's about understanding the market, doing your research, and making well-thought-out investment decisions. It's about being strategic, not reactive. So whether you're considering investing in stocks, bonds, or real estate, remember these fundamental principles. Familiarize yourself with the market you're investing in, understand the risks involved, and diversify your portfolio to balance those risks. These are the building blocks to becoming a successful investor. But remember, investing is not a guaranteed way to make money. It requires time, patience, and a willingness to learn. Remember, investing is not gambling. It's a strategic game that requires patience and knowledge. Now, let's demystify the stock market and talk about how you can start investing. The first thing you need to understand is that investing in the stock market is not a get-rich-quick scheme. It requires patience, research, and a good understanding of financial fundamentals. So where do you start? Let's break it down. Step 1. Set clear financial goals. Ask yourself why you want to invest in the stock market. Is it for retirement, to buy a house, or maybe to start your own business? By identifying your financial goals, you can determine how much money you need to invest and the level of risk you're comfortable taking. Step 2. Educate yourself. Before you begin investing, it's essential to understand the basics of the stock market. Learn about different types of investments, how they work, and the risks involved. There are plenty of resources available online, from blogs and podcasts to online courses and books. Step 3. Research companies. This is where the real work begins. Look for companies you believe in and understand. Analyze their financial health by looking at their earnings, revenue, and other important financial indicators. It's also crucial to understand the industry they operate in and their competition. Step 4. Understand financial statements. These documents are a goldmine of information. They can tell you a lot about a company's financial health and future prospects. Learn to read income statements, balance sheets, and cash flow statements. These will give you insights into a company's profitability, liabilities, and cash reserves. Step 5. Create a diversified portfolio. Don't put all your eggs in one basket. Invest in different companies across various sectors. This strategy will help spread the risk and increase the potential for returns. Step 6. Make your first investment. After thorough research and planning, it's time to take the plunge. You can do this through a brokerage account, which is a platform that allows you to buy and sell stocks. Remember, Start small and gradually increase your investments as you become more confident. Step 7. Monitor your investments. Investing in the stock market is not a set-and-forget type of deal. Regularly review your portfolio, keep an eye on market trends, and adjust your investments as needed. And finally, Step 8. Be patient. The stock market can be a roller coaster ride, but remember, the goal is to build wealth over the long term. Don't let short-term market fluctuations deter you from your financial goals. Congratulations! You've just made your first step into the world of stock market investing. Now, you're not just a spectator, but a participant in the economic growth of companies, industries, and the world. Remember, the journey to successful investing is a marathon, not a sprint. So, buckle up and enjoy the ride. Investing in the stock market is not without its pitfalls. It's a truth worth repeating, especially for those new to the game of investing. There are common missteps that can trip up even the savviest investor. And we're here to shine a light on those so you can sidestep them on your path to financial success. One of the most prevalent mistakes new investors make is allowing emotions to drive their decisions. When the market is riding high, it's easy to get swept up in the euphoria and jump on the bandwagon. Conversely, when the market takes a nosedive, panic can set in, leading to hasty decisions. Remember, the stock market is not a roller coaster ride, it's a marathon. The key is to stay focused on your long-term financial goals, not the fleeting ups and downs of the market. Another common pitfall is putting all your eggs in one basket, or in other words, neglecting to diversify your portfolio. While it's tempting to pour all your resources into that one hot stock, it's a risky move. A well-diversified portfolio, spread across different sectors and asset classes, can help cushion the blow of a poor-performing investment. Think of it as a safety net protecting your hard-earned money from the unpredictable swings of the market. Lastly, many new investors fall into the trap of failing to do their homework. In the world of investing, knowledge truly is power. You wouldn't buy a house without inspecting it first, right? Similarly, before investing in a company, it's crucial to understand its fundamentals, the industry it operates in, and its growth prospects. Make research your ally. It can make the difference between a profitable investment and a costly mistake. Avoiding these mistakes will put you on the path to successful investing. So remember, keep your emotions in check, diversify your portfolio, and never underestimate the value of thorough research. It's these simple yet effective strategies that can help you navigate the complex yet rewarding world of stock market investing. Let's recap what we've learned about successful investing in the stock market. We started our journey by unraveling the enigma of the stock market. We learned that the market is a complex and dynamic entity, a collective representation of millions of investors making individual decisions. This understanding is the first step towards successful investing. Next, we delved into the basics of investing. It's not just about buying low and selling high, it's about understanding financial statements, researching companies, and making informed decisions. We learned about the importance of diversification and the power of compound interest. These are the building blocks of an effective investment strategy. We then took a step-by-step journey into the world of stock market investing. We learned that investing isn't a get-rich-quick scheme, but a long-term commitment. We discussed how to create a diversified portfolio, how to analyze company financials, and how to make our first investment. It's a process that requires patience, research, and discipline. In our fourth chapter, we explored the common mistakes to avoid. We learned that investing isn't about following the herd or chasing the next big thing. It's not about letting emotions drive our decisions or neglecting to monitor our investments. These are pitfalls that can derail our investment journey. In summary, successful investing in the stock market involves understanding the market's nature, mastering investing basics, following a systematic investment process, and avoiding common mistakes. It's about being informed, being patient, and staying focused on our long-term goals. Investing is a journey filled with lessons to be learned, challenges to be overcome, and rewards to be reaped. It's a journey that requires us to keep learning, to keep adapting, and to keep making informed decisions. Remember, successful investing is a journey, not a destination. Stay informed, stay patient, and stay focused on your goals.